And in our top business story, S&P has affirmed Abu Dhabi's credit rating of AA, adding that the capital's budget would run at a deficit of around 5% of the Emirates' GDP from now until 2019. This comes after S&P's previous estimate for the period of a shortfall of around 1% of GDP, and below the 2% surplus estimate made before that. S&P added that it expected Abu Dhabi to maintain net assets of around 320% of GDP over 2016 to 2019, one of the highest net government asset ratios among the countries that it rates. It added that the widening in deficit reflects the agency's assumptions that the oil price will remain at around $46 per barrel over the next 3 years, down from its previous forecast of $73. S&P also affirmed that its ratings for Sharjah and Ras Al Khaimah. It said its continued AA1 rating for Sharjah reflects its view that the Emirates' public finances will remain strong, even as lower oil prices affect the Emirates' mining and energy industries. S&P also estimated that the Emirate would have a 2.8% annual growth rate for 2016 to 2018, down from the 3.5% that it forecast in November 2015. For Ras Al Khaimah, S&P also affirmed its rating of AA1, adding that it expected RAK's fiscal balance to remain in surplus and its debt burden low. As global trade is expected to increase by 3% this year, leading economists, analysts and commodity experts discussed future business strategies and possible solutions today to overcome the fall in global commodity prices in various sectors, including energy, agriculture and metals. Global commodity experts attending the 3rd edition of the Global Commodity Outlook Conference here in Dubai stated that lower prices for oil and commodities are likely to be with us for some time, as recent studies suggest that non-energy prices are expected to slip by 3.7% during the year, adding that market structures today need to adapt themselves to the current global trading environment. Experts highlighted that as the world's population is expected to increase to 9 billion in 2050, demand for commodities will also see an increase, but delivery mechanisms are going to change. Stating that Dubai and the UAE in general has weathered the impact of the fall in global oil prices, officials representing the UAE Ministry of Economy stated that the UAE Vision 2021 aims to build a competitive knowledge economy by increasing the non-oil real GDP growth to nearly 5% and also rising the net inflow of foreign direct investment to reach 5% of GDP.
And in a market today, from 2015 and early 2016, we've seen massive volatility. We've seen a collapse in commodity prices, and these create opportunities as well as threats. So we've seen traditional companies which have been based on origination and supply on the supply market, who have been devastated, from base metals to energy. But equally, you've seen companies which are out-and-out traders who had record years where they've made billion-dollar profits. So the opportunity here in a forum like this is to find people and a balance with intellect to find a roadmap forward in these challenging markets.
Dubai had to move from oil and diversify very early on out of necessity, and it proved with its track record how successful it can be. And even so, its big brother Abu Dhabi as well also started many years ago, even though it did not need to. But as you can see, they have diversified through many entities like Mubadala, like through Masdar City. They're looking at renewable energy. So they have been very successful, and they've been working on it for a long time. Definitely there will be an impact as oil is a very strong overall in the region, is a very strong contributor, whether it's directly or through consumer spending, let's say from tourism from the region. But I think the future, we are just going to continue with our plan, but it might just be accelerated. There just might be more innovation. We're looking at how to cut costs. I would even expect that because of the cost of oil, below $30 is not feasible. Maybe, I'm not sure, but maybe there will be some new innovation in the field. Regardless of that, I think it's very important for Dubai and the UAE to know what they instill. The values don't change. the way they look at things, the outlook, the values, and they have a vision.
During a discussion on the macroeconomic outlook, leading commodity experts stated that the UAE has successfully moved away from being an oil-based economy to a diversified economy by focusing more on innovation and building infrastructure, as it is expected to spend nearly 1.5% of its GDP on innovation this year. The conference, hosted by Richcom Global Services and DMCC, brings together over 400 traders, government policymakers, trade financiers and fund managers from across the globe, including Russia, the US, India, South Africa, Canada and Nigeria, to address key topics including the status of the global economy, oil prices and recession, agriculture and commodities.
Despite oil prices sliding, UAE has not given up on its investment program. So that investment program remains on track, and this is like a fiscal boost to the economy. So if you look at, historically, if you look at Abu Dhabi's oil investments, oil and gas investments, you will notice that in times of oil price fall, specifically in 2008, the investments were the highest. So when in times of trouble, they don't, stop investing in the sector. So they basically invest more to ensure that innovation and technology keeps pace with growing demand in the future. So I think in that regard, the investment program is on track. Infrastructure spending is big. So those things will help buoy the economy overall. Also consumer sentiment, of course things are down, like real estate has seen a correction. With oil low, consumer sentiments are a bit hurt. But if you see the overall economy, if you look at the roads, the roads are still jam-packed, the malls are full. So it's a consumer economy and that's still going for it.
UAE banks are being urged to adopt high-performance information management in order to support the rapid growth in mobile banking, according to industry experts. According to Bank Audi, as the UAE's e-commerce market is set to quadruple to $10 billion by 2018, GCC banks are aiming to expand digital and mobile consumer offerings, such as mobile payments, customer alerts, opening accounts and mortgages. A recent research paper from EY also showed that 81% of UAE customers would switch banks for a better digital experience, and 60% would move to a digital-only bank. It added that in the GCC and the UAE, only 34% of banking customers use mobile banking, and 55% are not satisfied with current offerings, especially due to the lack of real-time information and slow transaction speeds. Officials were quoted saying that banks in the UAE and the region need to accelerate their digital transformation to meet customer demands, with the cornerstone being high-performance information storage and management. They added that banking CIOs need to have the real-time and scalable solutions that enable them to work smarter with their data. Etihad-backed Jet Airways has declared its highest ever quarterly profit of $71 million in Q3 of the financial year 2016. Jet Group's total revenues for Q3 were $863 million, while passenger revenues were $733.7 million. Domestic capacity grew by 14.6% in the quarter, while passenger traffic grew 15%. In the international business, capacity grew by 2.6%, while growth in passenger traffic was 5.1%. Jet Airways also expanded its codeshare partnership with strategic partner Etihad Airways. Overall codeshare traffic witnessed growth of 28% from 416,816 passengers carried in Q3 of the financial year 2015 to 534,104 passengers in Q3 for the financial year 2016, with codeshare traffic with Etihad Airways and its partner airlines growing by 86%. Jet Airways, together with Etihad, now has the largest market share in Indian international traffic.